Actually, number one, apologies for that.
We have apologies from councillors Arlett, Gavashak, Romans and Plant, and I believe councillor Miller is substituting.
Thank you, councillor Miller. Item number two, declarations of interest. Item number three, public participation. We'll see questions and comments from members of the public. I know we have three people here. There are members of the public. Okay, moving on. Item number four, to approve the minutes of the meeting held on the 6th of December. Absolutely. Madam Mayor. Sorry, second up, please. Yeah, all in favour? Thank you. Item 4B, to note the notes of the Reading Road Working Group meeting held on the 14th of December. On proposal that we know those. Councillor Hamilton. I second those. All in favour? Thank you.
There's no, the meeting was cancelled on the, whenever it was, 20th.
There was a meeting planned, but
Yeah.
we're not ready to hold it.
Yeah.
And there will be another meeting scheduled for I've got the date in my diary.
It's on the back here. So
Yeah, there is a meeting scheduled for the where we will have things to discuss.
sorry, the meeting has the meeting we scheduled. That one.
We
Yes,
have
there is.
there is a meeting scheduled, yes.
Yeah, I've got one in my diary.
I can tell you when it is. Maybe the 17th of February, is that right?
That's on there already.
Yeah.
That's on there. So we just.
In that case, that's meeting, yeah. They'll notice we're going. Item 4C, to note the minutes of the Values and Money Working Group held on the 6th of December. I'll second that. All's in favour? Okay, thank you. That did actually feed into our previous meeting, which was held later that evening. Item number 5, finance, to receive the management accounts, bank reconciliations and summary payments. Any questions on these? I think I have one question. It's, on page. I may be misreading this, but I mean, they are very nice and clear generally, but the bottom diagram in page 21 of the agenda, which shows
The cumulative CPIH.
the
4%.
cumulative CPIH plus 4%. Am I that's the top line, isn't it? Which seems to be hovering. Yeah, that's what I thought. I thought, am I doing something stupid? Or wrong? Okay.
That graph is causing a lot of problems
Right.
last month as well.
Okay.
Oh, yes, thank you for pointing it out.
We have it a little bit bigger next time as well.
Yeah.
I mean,
Well,
these, I mean, they're important graphs and
Yeah.
that them a little bit bigger,
Yeah.
even if they go over 2 or 3 pages. It will help the council.
I mean, I know a lot of people say this about
Yeah.
the, particularly the agendas and documents on this committee. I'm fine. I'm short-sighted. So,
Yeah, but no, good point, no,
Okay.
I'll say that.
Thanks.
But it's going in the direction you'd expect it to go if it's higher.
yeah, it would change the.
Yeah.
It would be up. It would be up at sort of
Yes,
14% or so.
yeah.
Okay, can I have a proposal that we receive all these documents, please? And so Hillier seconding those, all in favour? Thank you. To consider the following items of expenditure, the wiring of £4,145 from the IT revenue budget to capital expenditure for the upgrading of the town hall Wi-Fi. So this has already been done, the money spent, and the Wi-Fi is available here for people to use. And I'm told it's very good.
It is very good.
Right.
Yes, it's very fast.
So, but now we will, I think our accountant has helpfully pointed out that we can remove this from revenues. It's really a capital expenditure, as it's an improvement to our infrastructure. So can we have a proposal to buy the better price?
Question, isn't it replacement?
It's
It's replacing
Well,
existing
To
one.
improve.
it is a vast improvement on the Wi-Fi that we've had previously.
Are the passcodes the same? I haven't tried them.
They are indeed,
Okay.
yes. Yeah.
I'm not doing that. Okay, so I have a proposal, Madam Mayor, that we via this cross, I'll second that. Any other comments? Okay, all those in favour? Okay. Investment management reports. Consider the council's investment policy and to receive reports from the council's investment manager. I think we've seen one from Redmayne Bentley, and I think we're going to get the Investec one at this point. So what we usually do is we invite you all up and come join at the table with the permission of the committee. Bring a chair and come join us. I don't know if
No, I'm absolutely fine, thank you.
you're welcome.
This is more the learning curve.
Okay, you're observing. But you're well, if you have got anything to contribute, feel free to.
Thank you very much.
And then you I'll take one, yes, I didn't prepare now for one.
Thank you very much.
Well, I read it already.
Yeah, I wasn't sure if they got out in time.
Yeah, no. I went through it. I didn't read it.
The quiz off.
No, it was the front page in particular, I read.
So I was comparing with my friends at work how much their portfolio has gone down compared to our pensions. I think you've done slightly better. Right, well, how we normally do this is that we do your presentations in turn, and then we do a Q&A. You can choose who to go first. Toss a coin, or I'll
Go first. You did it last time.
Okay.
Fine by me.
Right.
Thank you for having us this evening. In terms of looking at the last 12 months, starting first of all with your stated objectives, which are to be an excerpt of key areas from your investment policy document, providing income to meet your operational needs, longer term capital growth, to limit risk and volatility within the parameters of your stated attitude to risk. The attitude to risk for the portfolio with us was changed by the council just over a year ago, from cautious to moderate, and within that you are expecting us to maintain a maximum of 70% equity exposure, a maximum of 45% in non-sterling denominated assets, and as one of the more emerging and key areas, no holdings rated severe by Sustainalytics or similar metrics, and a target score of 20 to 30 for the portfolio when measured by the same. The current portfolio with us contains no holdings rated severe by those criteria and falls just below the middle of that target score. You've also asked us to exclude or work towards exclusion of direct investment in certain specified industries. You had 0.62% exposure to a specialty chemicals company that I don't sell just yet, but you are 99.38% there, as it were. Probably more important than just ticking the box in that regard, I would also mention that over a quarter of your portfolio with us is in explicitly ESG positive things. And I don't mean when we talked about this the last time we saw you, we talked about the fact that you can have lots of very limited companies that by some ESG metrics score very well, and by another metrics score poorly. I'm meaning more broadly in terms of things that are very primarily involved in things like social housing, renewable energy, and so on. This isn't a case of scoring a mining company because they have a diverse board or whatever. Probably most important from your point of view is outcomes. During the year, the total return on the portfolio was minus 7.37%. That's against a backdrop of there being nowhere to hide. In the calendar year, the S&P was down about 20%. Gilts had their worst year in a generation and were down just over 20%. Property and infrastructure and so on all fell markedly. And the biggest issue is interest rates. Even for asset-backed areas like infrastructure, people were willing to pay a premium when base rates were 0.1% to get a 5 or 6% yield. The scale of that premium has eroded dramatically as the gap between that 5 or 6% and base rates at now 3.5%. This isn't the case of, well, I'm willing to pay a premium because that's yielding me 50 times base rates. It's now yielding maybe 1.5 times base rates. Ultimately, most of those assets, or almost all of those assets, tend to be very heavily asset backed, and that will win out in the end. You know, they're secure, well-balanced assets that generate decent returns. I also think that there's an outlook. A lot of the pricing of those things has been based on some of the stories we were getting that have eased a bit about, you know, base rates could go to 6%, base rates could go, you know, inflation could not top out at 11%. And it does now appear that some, you know, consensus that base rates will have a bit further to go, but it's not going to be a rush to 6%. The benchmark ARC balanced index fell by 8.72% over the same period. And as a slight stop so far, 2023, it's early days, and touch wood, has been rather kinder to investors. As of this close of business last night, the portfolio has returned about 1.6% so far in January, helping to mitigate some of that. So in terms of current values, the current value as of the 17th, which was just the day I had to type this up, is shown, as I said, it's risen by about £26,000 since then. The estimated annual income, which I know is very material, is a shade below £60,000 at the moment. That's broadly in line with this point last year, but bear in mind you have drawn £100,000 of capital from each of the portfolios over the same period. So, you know, each £100,000 of capital one draws has an impact. So in real terms, it's a slight increase in total income per pound, as it were. And over the last year, effectively £156,953 has been paid away. Over the last 5 years, it's about £1.09 million that's been paid away from the portfolio. In terms of total returns, I've shown them in individual years purely because the change in the risk profile of the portfolio means that the benchmark that it's appropriate to measure it against has changed. So rather than doing a linear from year one onwards graph, it makes more sense to show against the relevant benchmark year by year. This year, as I say, it's, you know, somewhat less than benchmark, but it's certainly, you know, never going to go down as a great time. We've made some recent changes. One of the key things at the moment that I would say when one looks at valuations is that we have started to gently increase the equity exposure. At the moment, we're holding a reasonable amount of cash within the portfolio, but we don't envisage that being a long-term position. That's got more to do with the page with the pie chart, which is that your asset allocation under the cautious mandate necessarily involved a much higher weighting in gilts and fixed interests and bonds. That's come down as we've moved to reposition the portfolio to meet your new moderate attitude to risk for this portfolio. So the overall equity exposure has risen primarily through overseas equity exposure rather than UK equities. The UK market's been the one exception to last year being a terrible place, but that's almost entirely been down to the huge weightings in the FTSE of BP and Shell, which would preclude investment for these portfolios anyway. So the cash weighting at 7.8%, we wouldn't see as an ongoing thing. That's more the fact that we continue to reduce that fixed interest weighting and rotate that money into equities as and when we find them. The main reasons for last year, fairly well known, and I won't really dwell on them, but I think some of these will come back in 2023. We've had negatives in terms of issues in Ukraine and inflation and the knock-on impacts on interest rates and fears of recession. There are some positives in the latter part of the year as we've seen China move away from its attempts at a zero COVID policy. But I think going forward, any optimism has to be fairly cautious. If 2023 is a good year, it won't necessarily be because of the economic backdrop. It'll be because 2022 was a bad year, and therefore people are going to be looking for value and ultimately money has to find a home. And there are assets out there that are now at historically competitive prices. There will, I think, be a recession in numerous developed markets. There's been some talk of the last GDP figures in the UK show a little bit of growth. Does that mean we're going to avoid recession? I don't think so. I think it will be relatively lengthy but shallow. But there are problems in terms of when the weather thaws, things may well escalate between Russia and Ukraine. The fact that that's a relatively stalemated position at the moment won't stay that way forever. The markets will be looking at that. The graphic of growth projections by region is from the IMF and shows effectively that they expect very little growth in the euro area, in Europe, in the United States and so on. This was last updated by them in October. They're due to update this any day now. And that's likely to show further weakening in their projections for developed markets. I don't think there's an awful lot that suggests that the outlook has become rosier. So hence the view realistically that, you know, if 2023 offers value, it'll be because 2022 cheapened prices rather than because anyone is wildly happy about the state of the economy or global politics. That said, from our point of view, I think that it's the same as it's always been. It's been about finding decent quality assets that will be robust in the long run, and positioning accordingly to make sure that, you know, if things change and they are worse than expected, the portfolio will be robust enough to cope with that. And if things change and they are better than expected, the portfolio will be able to capitalize on it. That's about it from me, Charles.
That's what I was going to say.
Well, last year I seem to remember talking a bit about the main side of it and then saying, as far as the economy and everything, I'll say what Charles says.
That's just we let Charles do his presentation, and then we'll ask questions. We'll go on to
Okay, turning to the first page, the long-term performance of your portfolio. So I've been managing this since the end of 2008, 2009. Your portfolio has produced a return of 8.18% per annum over the long term, and it is the red line on the chart for your portfolio. So comfortably against all the various measures, benchmarks that we look at, save for the world index, which is very dominated by the US market, i.e. about 55% of the world index is made up of the US market, and that's been the dominant one over a very long period of time due to the high exposure to technology and growth stocks. So I think the performance looks reasonably good, as I say, on the longer term, but we'll come on to some nuances as we move further through the presentation. Turning over the page to the last 10 years, we can see where the performance has come from and the areas of the market that have struggled. So fixed interest, we'll see in the top part of the table, has really struggled over the last 10 years, producing a total return typically in the 37% area for you, significantly ahead of the governmental stocks index, and then 25% return from overseas fixed interest, but a pretty lackluster return over the 10-year period from fixed interest securities, which is hardly surprising when one looks at the prevailing interest rate over this period, which was very, very low. But in contrast, we then move down to the equity area, and you'll see that the all-share index, i.e. representing the majority of UK companies, the benchmark was up 88%, your portfolio in this area was up 112%. So we've added some value against the all-share index. But the real star has been the S&P 500, the US market, which, as you can see, the index up 341%. And we've captured some of it, but sadly, not all of it. But nevertheless, the performance twice as good from the US as from the UK. And we have been steadily over the 10-year period, moving away from a UK-centric portfolio to much more exposure to the overseas markets and therefore capturing this growth. The other feature I would say is in this 10-year period, per annum, 6.73%. So it's clearly not as good as the much longer term performance of 8.1%. And then we drill down to a much shorter period over the page, 1-year performance. Nick has already alluded to the fact that it's been a pretty tough year, and I thoroughly concur with that.
Lot of red numbers there.
A lot of red numbers there. Your portfolio is down 10% in this period, compared with the benchmark. I'm not sure I've ever been told that the benchmark has changed from RPI plus 3.5 to CPIH plus 4, but I obviously have picked it up in this document this evening, but I'm not sure I've officially ever been told that. I know we discussed it, and I know there was a potential review at some point, and it was discussed at that point. But so I'm still working on the RPI plus 3.5, but I have included CPI H plus 4 in the presentation performance further along. So yes, a very difficult year. The defensive things, which you would imagine would be fixed interest securities, clearly have performed very badly. So UK government stocks down 23% in this period. Index linked stocks even worse. Why is that? You would expect inflation proofed in an inflationary environment, you would expect them to go up and perform well, but they haven't because of the duration that's in them, the much lower level of income that's generated. They haven't proved defensive. They are not designed to protect you from rising inflation in the short term when yields go up. Over the longer term, then their inflation protection qualities begin to work, but in the short period that we're looking at, they have not proved to be a good defensive counter in this very strong rising interest rate environment, rising inflation environment. Turning over the page, we had a few years ago, and I forget when it was imposed, I would think, was it 3 years ago now? 2 years ago? 2 or 3 years ago. Various sectors that we're not allowed to have exposure to, oils, mining, gambling, tobacco, and chemicals. And so trying to exclude them from the performance data, essentially that would have knocked 7.3% off the portfolio performance from the UK element of the portfolio. And as you can see from the chart, the oil stocks produced a return of 47% over the last year, and we've got no exposure to that. Similarly, tobacco up 30% on a total return basis, mining stocks up 20%. It is what it is. I'm not allowed to invest in those areas, but it's had a negative 7% impact on the UK element of your portfolio. Turning over the page, I put in some data from Asset Risk Consultants, which was the independent measurement group, and that assesses our firm and Nick's firm and 100 other firms around in the city. So there are 100 contributors to this survey. And what this essentially shows is that over time, your portfolio, which had been in the ARC balanced category with a 40 to 60% risk relative to the world equities, has moved up as we've moved out of fixed interest securities because the rates of return are so poor towards more equities. Now, your portfolio still falls within the medium risk category. And if you look at the little chart in the middle, from low to high, it's clearly bang in the middle in terms of risk. But nevertheless, in terms of the measurement of the portfolio, because of the higher equity weighting that we've now got, it has moved into the steady growth category. And so again, we've adjusted the performance data that I presented earlier to show the performance against balanced assets and then steady growth as measured by ARC. The interesting thing, I think, for me is how we've been pretty consistently in the first quartile over the last three years at every quarter date. Unfortunately, this data is always about 6 weeks behind the end of the year, so I can only go to September 22. But nevertheless, it gives you a flavour of how you're doing. But what is very obvious is that the imposition of the various constraints, restrictions, is really beginning to have an impact on the overall performance of your portfolio. So although I can with confidence say that we've consistently over a 10-year period been in the top quartile against all these, the peer group, there is no doubt our performance is beginning to tail off because of the dominant performance of oil stocks, mining stocks, tobacco stocks, etc., etc. So we can't hide from that fact that this data is clearly showing the deterioration in the rate of return that we're achieving for you. Turning over the page, one of the other aspects to look at, of course, is the risk that we're taking. Now, I've already mentioned that we've moved out of their risk category of balanced asset into steady growth. But the risk is still consistent with your overall medium risk categorization. So there's nothing to be concerned about there, and looking at the drawdowns and the volatility, there is nothing untowards there in terms of the risk analysis. But as I say, looking at the portfolio performance over the last quarter, it's not been so good. Over the last year, it's not been so good relative to this peer group because of the exclusions that we're bound by. So over 10 years, good. Over the shorter period, not so good. Turning then to the other important issue for you, and that is, and that is income. Income for you is important. So the original and long-standing objective is to achieve in excess of 75,000 per annum, and I think, Nick, you mentioned a figure of about 60 something when you put on a small capital base.
It's
about
3 points, can't remember now, 3.6%.
Yeah. So what I've done is produced a table showing the evolution of the portfolio in capital terms, the income that's generated in each of the years. So we've clearly met the expectation there, but equally, and again, as Nick has mentioned, over the years, we've had sizable capital sums out, and then adjusting for the capital going out, the impact on the income is reflected in the right-hand column. I think, and it's difficult to calculate, I've managed to increase your income at about 2.2% per annum over this period, which is pretty much bang in line with CPI, the rate of growth in CPI over this 10-year period. But of course, the point I'm trying to make is it is difficult to meet the expectation of the £75,000 worth of income if capital sums are coming out. Now, I know as a council, you need to spend that capital. I understand that. But so we are running quite hard to achieve your objectives. But I thought this was quite useful so you get a sense of the overview of the evolution of the portfolio over time and the income that it generates. Nick talked about the ESG criteria. I've run the data through the Sustainalytics system, and of course we can only measure direct equities. It can't analyze the managed funds. So these are the direct equities in your portfolio, and this produces an overall ESG score of 18.8. So substantially below the UK index level of 22.3, and all of the categories are either medium or low or negligible in one case, so that there is nothing that falls in the severe category. And looking at how these companies compare to their sectors, to the other companies, you'll see that they all fall very much towards the bottom percentile against whether it's construction materials or utilities or whatever it is. They are the class leading names in terms of ESG in those sectors. And just very quickly coming on to what I think is going on in the world, and this is reflected in the two charts on the left-hand side, UK government securities yields from a year ago until now, a dramatic rise for 10-year gilts going from about 1.2 up to the current level of about 3.5%. That's a very dramatic rise. And if you do the calculation, it's about a 36% change, which if you then run the numbers through against the price earnings ratio for the market, it's no surprise to see so many UK companies that fell by 35% last year. Luckily, we haven't had too many of those, but there was a huge raft of companies that just got derated last year. So just a purely mechanical, mathematical calculation of the value of the UK equity market based on this fall in government debt or rise in yields. Same thing in the US, but the interesting thing in the US is the way the yield curve is shaped, and that is in technical terms is described as inverted. In other words, short rates are higher than long rates, and in 85% of the time over the last 75 years or maybe 100 years, I forget, it has then led to recession about a year, sometimes 18 months, something of that order, a recession to come. So it's a pretty good predictive tool for gauging whether a recession is coming. We can be much more certain, turning over the page, about a recession coming in Europe and in the UK. We're probably in a recession in the UK at the moment, and I think our views very much concur with Nick's. I put in some consensus GDP forecasts, which you can see for the year just gone. Not too bad a year in terms of economic growth, rebounding from the COVID lockdown period and latent strength there, but 23 clearly very weak in most of the major economies, Europe in particular, UK in particular. But the interesting thing is the recovery that we're beginning to sense and see in China. And as you know, their draconian lockdown measures have had a very significant impact on their economy, very significant impact on the supply chains for the Western world. But the relaxation, the unfettering of their population is beginning to be reflected in retail sales, rallying very sharply, industrial production ramping up very sharply just in the last 2 to 3 weeks. And as we enter the year of the rabbit and the Chinese New Year, there's clearly a lot of momentum that's building up in the Chinese economy following the lockdowns. And so most of the forecasts are suggesting reasonable growth coming in China after the pretty poor period in 2022. And as you know, China is the second largest economy and accounts for something like 40% of world growth. So it's pretty significant in what's happening around the world. And then just finally, I've looked at some measures of the stock markets as opposed to the bond markets, which we talked about earlier. The chart on the last page shows the collapse in the valuation, the price earnings ratio in the UK and the US. Clearly, quite a big divergence. The UK has been significantly weaker. And arguably on this long run chart, the UK is beginning to look really quite good value at something like 10 times earnings. That's not bad value, assuming the earnings can be counted upon. And we don't know whether those earnings can be counted on. It's very difficult to gauge. If it's a deep recession, which we don't think it will be, so we agree with Nick, a relatively mild recession, then profit margins could easily fall back from the 9 to 10 to 11% range back to the long run range that they reached in previous recessions of 4 or 5%. And then these earnings multiples will look quite stretched. But it's almost impossible to gauge what is going on at the moment because it's so difficult, as companies will tell you, how they are dealing with their input costs, how much pricing they can then push through to their customers, and whether customers will then pay those higher prices or whether they'll trade down. So, you know, we heard from Procter & Gamble a day or so ago, and it's pretty clear they pushed through price increases for toothpaste and deodorant, et cetera, of about 10 or 11%. But then they find that people can't afford that. So they're trading down to the unbranded stuff, so their sales then drop, etc. So companies need to try and protect their margins, and it's very difficult to analyze how that will play out. So I'm being a bit vague about it, because the honest answer is, I just don't know. I don't think any analysts know at this stage. But nevertheless, markets, we think, have corrected down to relatively attractive levels, but it will be a fairly difficult year. But the signs are that over the year, as the economic news gets worse, we may find a level where the markets start moving to the next business cycle and start performing better, and certainly better than 2022, which was a pretty grim year for all of us.
Thank you, Charles. It was a interesting presentation as ever. Thank you for that, and thank you for the charts. As I said, I'm going to have a Q&A session now, which we'll try and keep reasonably short. We're going to go around the table so we can get a chance to do that. So, Madam Mayor, can we start with you?
No, I haven't got any questions. I'm just thank you very much for your thorough presentations, and it's no surprise, basically. You know, we all see the news, we all know what's going on, and yeah, unfortunately, it's no surprise.
Yes.
That's awesome.
Yeah, I've got a few questions here, as it were. Nick, if I start with you, this council signed up to a climate emergency. All right, this council didn't sign up for veganism, and this council didn't sign up for Just Stop Oil. Yet we have decided, wrongly in my view, to take our portfolio out of oil and gas, and that has been critical in the development of this portfolio, because I've got a problem with tobacco and I wouldn't invest in tobacco, but I would invest in oil and gas. And the reason for that is BP and Shell aren't necessarily bad companies. Yes, they take stuff out of the ground, but they're also investing in renewables. And by excluding us from oil and gas, we are effectively excluding 7.3% or whatever. You say we're 93% clean as a portfolio. If I was being polar, you could say, well, we're 93% clean, 7% dirty, as it were. But by excluding oil and gas in that strategy, we have put ourselves in a position.
Can you move on to your question?
Yeah.
We're
Yeah.
listening to time to speak,
But
we're asking questions.
No, I'm not coming to that. So the first thing is, are we wise to exclude oil and gas, or is there a way that we can invest in oil and gas but invest in more renewable versus perhaps dirty fuels?
I think are you wise? It is a personal choice. You know, I think fundamentally they're legal businesses, and I think they are taking a different approach to maybe about 15 years ago. BP changed the logo, beyond petroleum ads and all this, and they greenwashed. Basically, they invested in a load of renewable stuff that they then shut down, wound down, and walked away from. Now, I think, the major oil companies all know they need a future, and their future is not going to look like their past. And so they have become much more interested in doing what they do better and investing in the next stage of the energy cycle, which is not going to be oil coming out the ground and being just burnt off. So, there is a case for saying that also some of the biggest investors in renewables are these cash-rich energy giants, because someone's got to make the investments. That said, and which was a point when you guys spoke about this previously, and so on. I think you had the town's climate emergency working group had someone attended, and they made the same point. But at the end of the day, the question about does it impact returns this year? Yes. The year before, less so, because during COVID, the price of oil was collapsing and the price of oil companies fell to bits. It's a case of having the capacity to say, it's not about saying it's a bad thing to be out of them. It's about in some years it'll be a good thing, in some years it'll be a bad thing. What it does from our point of view is that those series of exclusions, for example, probably remove somewhere between 40 and 45% of the market capitalization of the FTSE 100, for example, from our radar, between all of the various exclusions, which is fine. They'll do it the way you want to do it, and that's okay. And it's always the client's prerogative, as long as the client accepts the fact that might, in some years, have an impact on returns. And also, a lot of those are some of the biggest income generators available to an investment manager. That's where you go to look for your dividends in a lot of cases.
But are we able to model, if we had left oil and gas in there, how much would the portfolio not have gone down?
I think it probably would have mitigated this year. It probably would have mitigated your 7.3% down to about 3%.
So over half of the loss of the portfolio is because we're now no longer in oil and gas.
Over that particular
Over this particular
12-month period,
yeah.
yes. In other 12-month periods, it may be the opposite, where it saves you from a potential loss.
Yeah.
I think that trying to say good thing, bad thing.
No, I'm not saying
in
that.
some periods it'll be.
I just want to highlight, I think it's important to highlight to the electorate that because we're not investing in oil and gas, our portfolio is down by over half of the decrease is because we're not in those two sectors.
I think the second part of what you asked about looking at investing in other areas within energy and so on. I mean, we hold a lot of investments in the portfolio in renewables and wind and so on and so forth. They're at a different stage though, so they don't, as it happens, there's an anomaly, which is they have thrown off a lot of cash over the last 12 to 18 months because electricity prices have been very high. So they've actually done relatively well. Generally speaking, those businesses are at an earlier stage where they need investment rather than throw off cash, which is the sign of a more mature business. So that has helped to mitigate to some extent. But on the other hand, they're also seen largely as infrastructure vehicles with high yields, which become less attractive in relation to rising interest rates. So there's a, yes, there is still a heavy energy presence in the portfolio of a type that you guys do find acceptable. Yes, it's done okay over the last year, but no, it's not done as well as holding a pumping great pile of Shell would have done. But them's the breaks from my point of view, I guess.
The second point I wanted to question is clearly these portfolios aren't growing as quick as fast as they used to. You highlight the point of performance, and the point there is to the councillors, we've got to get ourselves off of taking.
Can you ask a question?
Yeah,
We're asking questions of our managers. They come along to give us the benefit of their advice.
Okay.
Can you restrict yourself to asking questions?
I can ask a question then. If the growth is not so significant, the drawdowns should be less from the council, should they not?
It's the council's money, they can draw down what they wish, but I think it is certainly the case that if you had gone to a previous period a few years ago when there was both growth and income available, it's easier to turn around and say, we need £100,000 for a capital project. Fine, it'll cost us, call it £3,000 in income. But it'll come out in the wash. In tough years like this, it really does show, because when you're going backwards on capital and there is an impact on income from drawdowns, yes, those drawdowns will be more keenly felt in difficult times, absolutely.
And given the last question is on risk.
Sorry, could I respond just?
Yeah, Ted, I would just like to come back on that,
Just very
that one question about the drawdown, the income.
Indeed, so drawdown for capital projects, I suppose it would very much depend on those capital projects. So for example, the last drawdown, which was for about 250,000, for example, this year we've seen a 20% return on that versus a minus 7.87% return, whatever. So I think it would very much depend on the capital projects in question.
And the third question is on risk. Given that the economic uncertainty is indicating a shallow recession, although the UK is performing quite well. We had a low risk strategy for both of you. We then moved one of the portfolios to a medium risk strategy, and then we changed your portfolio back to a medium risk portfolio. On a level of 1 to 6, should we be knocking it back to say 3 or rather than 4 in terms of risk?
I think
for the next year.
I think that the thing that is probably most important is that the council is clear about its view of risk over, say, a 10-year timeframe. I think being reactive to a bad year, we feel bruised, we must take less risk, sort of is counterintuitive, because actually it's in the bad year, after the bad years, where actually a bit more equities, there's some value there, and those are the things that set you up for the not for lights out years later. Usually it's the case of trying to make sure things are positioned to take advantage of the good stuff. So we've upped the equity weighting as a result of that change. We haven't raced to your 70% threshold or anything like that, and we don't really plan to. We've sort of very gingerishly, as timing has allowed, made changes to reposition. We haven't taken a red pen to the portfolio and jumped from the frying pan into the fire. So we're somewhere where it now classes as moderate by the way we measure volatility and so on. It's not a million miles over the threshold of the overlap between cautious and moderate anyway. And I certainly wouldn't be envisaging rushing to the top end of that either. Because I do think that, as Charles has said, there are an awful lot of uncertainties in the world at the moment, and there may well be value there, but there are risks there as well.
And I just also then answer.
Sorry, go on, Charles.
From my perspective, from 2009, I have maintained a medium risk portfolio consistently. What has changed within the parameters is that I have tilted the portfolio towards more equity. So we've currently got 64% in equity exposure. Our maximum would be 70%. And we have moved away from about 26% in fixed interest, because there's no obvious returns that we were able to capture there, which I explained in the performance analysis. And we're now down to about 17% in fixed interest. But conversely or commensurately, we've increased the alternative assets instead of the fixed interest things. So those renewable energy things, infrastructure funds, etc., to get the the level of income that you require, and things that are inflation linked in terms of their operations to get a rising stream of income. Hence me saying that I achieved about 2% increase over the long term in your income year in, year out, which essentially has matched CPI over that period. They're still very comfortably in the middle ground of a medium risk portfolio, because it's like tilt and emphasis within construction.
That's helpful clarification. You have a question?
Yeah, just a quick one. So obviously about a year ago, we recognised that the Redmayne Bentley portfolio was the the appetite for risk that you assessed as having was in the ARC cautious band, whereas Investec feels is in the ARC balanced. And so what we did is that we then reviewed the appetite for risk with Brimley and Bentley in order to bring that into the ARC balance. And of course, we see that now the Investec has nudged slightly into the steady growth band. So I suppose the question is, what my concern would be that we don't create the same problem again, where we're then comparing apples and pears when we're looking at the two portfolios. And so my question was really, is probably more to Brimley and Bentley, as I know this just nudged into the steady growth. Would you say that that our assessment of risk with yourselves is broadly commensurate with Investec, and therefore we can now compare like with like?
Broadly speaking, yes. I mean, we are at the moment very much in the ARC balanced sort of universe at the moment. I suppose the question is there anything wrong with having apples and pears? Realistically, as long as the council look at it and say, these are slightly different beasts for slightly different reasons to achieve a blended outcome, which is what we're happy with, then I'm not sure that it's a bad thing to have an apple and a pear, as long as you recognise that they're not going to taste the same.
And the evidence is your better performance over the last year than mine, because you were more defensive, and I think you said a -7.
Knock the lights out in a bit.
And we were -10. And so they are quite a good counterbalance to each other, which
Yes, the point of having a lower risk is that in a bad year you're less exposed.
Yeah.
Absolutely. So yes. I've got some very detailed questions. You helpfully, Charles, gave the ESG rating your portfolio 18.8. Nick, did you have is yours in the report?
It's not. No, we don't sort of report on a Sustainalytics basis. I run the Sustainalytics number for the direct equities. I think the comment I would make is in line with Charles's, which is it's helpful, but not that helpful, because it doesn't cover a lot of the things in the portfolio. Yeah. In terms of the direct equities, I think we came out at 22, 21.8, 22, nothing in severe. Again, the categorization is almost across the board, low and medium. And actually the ironies are things like, we also, like Charles, hold SSE in the portfolio, one of the biggest renewable generators in the country, and it actually scores quite high, and is a moderate ESG risk by Sustainalytics. So
it's a bit of dark art.
These things are a bit of a, it depends which ESG scoring tool you ask as to how these things come out. But I did, because you specify in your investment policy Sustainalytics or similar, I did run the individual equities. I think it's 21.8 as a so it's slightly higher.
It's helpful to hear that. I noticed in your report you said that the target score was 20 to 30, and we did amend that to below 25 or below. Last year, I think, and we may not have passed it.
My apologies.
I doubt it. Given that you're at 21,
it's as I say, it's I'm comfortably enough, but it's still within. But I'll note
it's worthwhile making sure that you're
pick up on.
The other thing that was worth noting on the revenue side, you stated that the target is to provide 7,500 in annual revenue for it. And in fact, we budgeted for 120,000 this year. We are that's in our budget. I can't remember for next year, but it's probably similar. We do recognise that times have changed, and the days when we got between years of 160, 165, 170 are probably not going to come back in the short term. Please do if you can, but yes, the bodies have gone.
So and that's on the annual revenue. The capital drawdown is a different thing, which as Sam made the point very neatly that let's say we're getting a 20% return on the 200,000 we've invested in the venture goals, and obviously that represents a pretty good investment for us. And it's not always straightforward to measure these things in a simple graph. I think that's the questions that I have. So, Liz, you want to ask anything?
Just bring up on to something you said then. For both of you, if you were to do our budget and show what income should have next year from this, what would you be budgeting?
The figure I gave in there is the estimated annual income is the forecast yield.
Which one was that?
59,000.
It looks about right, yes.
and some pounds. 59,237 pounds.
60 grand each.
Oh, right, okay, got it.
If anything, I would expect it to be higher than that, because again, that's based on last year's declared dividends, and until a company, you actually, a lot of the businesses in there, one would expect a degree of dividend growth from, so I would expect it to come out on the other side of 60,000 pounds. I mean, in some ways, the key thing is the yield figure, because one of the reasons why you guys 5-6 years ago made the change was that your Rathbones portfolio was yielding a lot less than the Investec portfolio. And part of this has been about trying to bring the yield up in percentage terms, rather than necessarily absolute monetary terms, in percentage terms, to the point where they're on more of a par. What's effectively happened is that when I first started, Charles was yielding about 4%, and the Rathbones portfolio was yielding 2.5%. Is that Charles? The changes in your investment policies and excluding certain areas and just changes in the market, I mean, Charles's yields come down a bit. The yield on this portfolio has come up a bit. And so I think the yield figure is probably a lot closer than it's ever been there.
Yeah, we're running at about 4%.
Yeah.
And it's been, on that table I put forward of the income, it's been hovering around the between 3.8 and just over 4, occasionally when there's some special dividends.
But I would expect that by the sounds of it, from what Charles is saying and from what we've suggested, that you should come in north of the 120 that you're budgeting.
Yeah, we try and budget cautiously. Yes, I'm encouraged to do that by officers. Sarah.
No, nothing for me, just thank you very much for your reports, they're very clear and much appreciated. Thank you very much.
Yeah, no questions from me, but thank you, because you make it easier to understand.
Yeah, the same for me, yeah, I'm not surprised.
Okay, that's good. Remember, so much longer to ask their questions. Okay, is there any more you want to add? Okay, thank you very much for your presentations. And you I don't think you're aware that there'll be elections in May. So the next time you come before us, some of us may have changed, some of us may not be here. And so thank you. You've been for the full 4 years that you've been attending and giving your views, explaining some of the facts of economic life to us. Councillor Hamilton,
Yeah, in the back of this agenda, we have the investment policy.
we do have an investment policy to review. Yeah.
Are we going to do that now with the investment managers here, or we're going to do it? Because if we are to review it and make any changes to it.
We're not proposing any changes.
What? Are we? Hang on, I'd like to debate the oil and gas issues.
Yeah, okay.
Well, see whether we allow that category back in.
This item on the agenda does cover the investment view, so we'll do that in a moment.
Okay.
But the investment managers are welcome to attend, but unless they have any particular specific suggestions to make, which I think we've already heard their views, then I don't think we will need to be at the table. I'm not sure it would be appropriate in any case. But yeah, we're going to discuss the policy now.
Okay.
My only comment with regard to that is that whatever, should you make any alterations at all, could someone please formally let us know as soon as, so that we make sure, it's important that we hold a current version of all things, so adopt any changes.
That's a very, very fair point. There isn't really much point making changes.
No.
And that's to tell you.
Sometimes there's a gap between you guys are sort of talking about something or thinking about it, and the point where it's actually adopted, it's just so that we're.
That's a very sensible,
Hence my reference to CPIH.
yeah.
Which I call for an act, yeah.
We discussed it with you, and it was with your, not sorry, senators, you were happy with the change. Made a lot of sense,
Yeah.
but yeah, apologies for not formally moving it to give them. I mean, it just actually very much difference in practice.
No,
It doesn't.
no.
Okay,
Still,
thank you very much.
unbeatable, I think.
Thank you very much.
Okay, so in item number 7, it says we are to consider the council's investment policy, and do we formally, do we have to review that every year? That's not an agreement, or we make changes?
We don't have to review it every. It's complete with the council's discretion as to how often they approve it. I can't remember off the top of my head, but the formal advice is on how often it is approved. But most policies would be either annual or biannual.
It would be sensible for us to approve it either as it is, on the agenda, or with any amendments that councillors wish to propose. Right, I propose therefore that we approve the policy as on the agenda. Second for that.
I'll check that.
Okay.
Yeah, so this policy was put forward, and this is the initial draft as of today. So this must have come from a previous version. That's correct, yeah? A year ago,
Yes.
pretty much a year ago. Clearly, Redmayne Bentley have excluded oil and gas, tobacco, chemicals, mining, and gambling. And my view is that it could be worth us relaxing the rules on oil and gas to pick up on the renewables. That doesn't mean to say that we're not going to be net zero by 2030, whatever the objective is. That doesn't mean to say we're not climate emergency friendly. But what it allows us to do is to pick up on some of that income that is renewables. And if you look at what the growth that we've lost by not being in the oil and gas category this year, it might be worth including, it might be worth relaxing that one category for this year, and then picking up, I think, reviewing it again in a year's time.
Well, it's a shame it didn't come with that suggestion a year ago, having foreseen the turmoil in the energy market.
Didn't have a crystal
but of course,
ball.
well, exactly. With the benefit of hindsight, it's fine to come along and suggest what did well last year. We should do this year. I'm not sure whether you're suggesting we should invest in them because they're a good investment, or because they're oil and gas. It's not quite clear to me.
I'm suggesting we relax that category. Okay, just that one
So
category.
there are two reasons two driving forces here. One is that we wish to optimize our investments for financial benefit.
Yeah.
And the other is to conduct ourselves in a way that we regard as responsible to members of the community and the wider world in the way that we invest financially. And this committee this council took the decision that we should follow what we're saying on the climate emergency and avoid investments in oil and gas and other fossil fuel companies. And as the investment managers made quite clear in 2021, that turned out to be economically sound because they were doing poorly. Of course, things are very different this year. Things are very different again in 2023. So I don't quite understand why you feel a change is necessary now, even with the benefit of hindsight. So,
We signed up to divestment at the beginning of the last cycle. And we all agreed that because there is a climate crisis. So you can deny climate crisis all you like. We're not taking a backward step and investing in fossil fuels that are going to damage the planet. Okay, it's a backward step. Okay, something else will come along and we can make a better investment in that. But telling us to take a backward step into that really is irresponsible.
I did totally, I'll answer the question
Okay.
because it's the end of it. It is not a backward step. What it, hang on,
Hold on,
Hang on.
let's not interrupt each other, okay? So.
It's not a backward
give us
step.
chance at the moment.
and you're wrong to say it's a backward step. What you have to realise is investing in renewables through companies like BP that are responsible companies and Shell that are responsible companies is actually investing for a greener future. And therefore it's going forward and looking to pick up on that growth. And in my view, that's what we, just in that one category, I wouldn't touch gambling, mining, chemicals or tobacco. But just in that one category, I think we should relax the objectives of the investment manager. But if that's not your view, that's fine.
I just wanted to pick up on a couple of pieces of advice they gave us. And that was, it's the length of time in the market, okay? It's that makes good investment sense. It's not to be reactionary. So that's two really good pieces of advice that anyone or any group or, you know, everyone in the market should take. He has confirmed that we are on course to meet our budget with the investment strategy that we have. So I see no reason to change it.
Thank you. Very sensible. Anyone else like to comment? I will just make one last point, which is that the argument that we should be investing in renewables and other clean and safe forms of investment in energy and other parts of commercial activities is a very sensible one, and that's one that we should be doing. But there are plenty of companies which solely invest in develop renewable technology and sell it and deploy it, and leaving our investment managers to do those, guided by our ESG strategy, seems to be the right thing to do. And I think the Mayor is exactly right in saying you've got to take a longer term view than just 1 9-month period where a completely unpredictable event has taken place. Okay, so we have a proposal to adopt the policy as on the agenda. And it's been seconded. I'll go to the vote. All those in favour? Okay, thank you. There we go. Okay. Item 8, exclusion of public interest. Thank you very much for the House for attending. Nice to see you here again. So I propose that we consider the public interest be excluded from the remainder of the meeting in accordance with the Public Body Admissions to Meetings Act 1960, publicity would be prejudicial to the public interest by reason of the confidential